Are you looking to build a $1 million portfolio? If so, this video is for you. ETFs have become a popular choice among investors, offering diversification, low cost, and ease of trading. We've analyzed the market and identified 6 ETFs that can help you achieve this goal. And we'll go over 6 different categories of ETFs and the best ETFs in each category. Without further ado, let's start with the first one, Core Equity ETF. To start off, it's important to establish a central investment that forms the backbone of your portfolio. While it's possible to have other investments, this core holding typically accounts for more than half of your overall portfolio. One strategy that has been widely used with success is to invest in an ETF that mirrors the entire market, serving as your core holding. In this category, one potential option is the Vanguard Total World Stock ETF. By investing in VT, you gain exposure to the global stock market, including large, mid, and small cap stocks from both developed and emerging markets worldwide. This ETF aims to track the performance of the global stock market and provide a comprehensive investment solution for your portfolio. VT holds a total of 9,500 stocks, and I'm sure that you have heard of some of the largest holdings, which includes names like Apple, Microsoft, Amazon, Nvidia, Google, and Tesla. This ETF has an average return of 8.11% over the past 10 years. This means if you have invested $1,000 10 years ago, your investment will have grown to about $2,181, even with the recent volatility rising from bank failures and recession fears. Of course, while past performance is definitely not a guarantee of future results, a strong track record performance and businesses getting bigger and earning more generally means the global stock market goes up in the long term. Talking about dividends, VT isn't a dividend-focused ETF, but it still has a dividend yield of 2.06%. As with any ETF, there are fees involved. Fortunately, VT has a very small expense ratio of only 0.07%. Next, Fixed Income ETF. The next category we have is Fixed Income ETF. Investors can use an ETF from this category to reduce portfolio volatility and for diversification purposes. Furthermore, since bonds are generally less risky assets compared to stocks, they are more suitable for retirement and investors with a lower risk profile, as well as those who are seeking for a steady stream of cash flow. For this category, we have the Nickel AM SGD Investment Grade Corporate Bond ETF, which main objective is to provide investors with the investment returns that correspond closely to the total return of the iBoxx SGD Non-Sovereign Large Cap Investment Grade Index. This ETF holds more than 100 bonds. Of these bonds, the largest holdings are in DBS, Temasek, and HSBC, which constitute about 2.5 to 3% each. Bonds under this ETF are stable yielding, high-quality companies that have a consistent track record of paying dividends. Since its inception, this ETF has an average return of 0.94%. This means if you have invested $1,000 since its inception, your investment will have grown to about $1,000.45. Now, fixed income is generally considered safer assets compared to equities, so the returns are relatively lower, but it makes up in the dividend section. When it comes to dividends, MBH offers a general yield of 4.48%. Additionally, the expense ratio for this ETF is relatively low, costing just 0.3% per year. Next, for the regional equity category, the Premier Dow Jones EM ASEAN provides investors exposure to the ASEAN region, giving an extra flavor in your portfolio. The main objective of the ETF is to track the Dow Jones Emerging ASEAN Titans 100 Index, which consists of the top 100 companies from Indonesia, Malaysia, Philippines, Thailand, and Vietnam, selected based on the float-adjusted market cap, revenue, and net income. This ETF has slightly more than 100 holdings, and the top holdings are Bank Central Asia, Bank Rakyat, which constitute about 6.7% and 4.9% respectively. Since its inception, this ETF has an average return of negative 0.79%. Although the returns have not been phenomenal since inception in 2018, there are strong tailwinds from factors like the growing number of middle-income families and the increase in adoption of technology, which has long-term opportunities for growth looking ahead. In terms of dividends, this ETF provides a yield of 1.89%. Moreover, the expense ratio is relatively affordable, with a cost of only 0.5% per annum. Next, the single market equity ETF. As for the single market category, our pick is the iShares MSCI India ETF. It provides investors exposure to the performance of large and mid-cap companies of the Indian stock market. This ETF holds over 100 different stocks, and its largest holding is Reliance Industries, which is a multinational conglomerate spanning multiple industries such as energy, petrochemicals, natural gas, and telecommunications. With India's population surpassing China recently, its economy is poised to keep growing robustly due to population growth and digitalization. Although there are some near-term risks, such as expensive valuations and allegations of corporate scandals, the long-term growth trajectory remains intact on the back of synergistic domestic tailwinds, as well as positive reforms within the country. So if you are a patient investor with multi-year investment horizon, you can consider this ETF. In the last decade, this ETF has delivered an annual return of 5.86%. If you have invested $1,000 10 years ago, your investment will have appreciated to approximately $1,567 today. This ETF also has a reasonably priced expense ratio of 0.64% per year. Next, the commodity ETF. The next category is commodity ETF. Investors can consider a commodities-related ETF in their portfolio for diversification, since on average, commodities have low or negative correlations with stocks and bonds. In a diversified portfolio, asset classes tend not to move in sync with one another, which tends to reduce the volatility of the overall portfolio and should improve the consistency of returns over time. Under this category, our suggested ETF will be the SPDR S&P Global Natural Resources ETF, which seeks to provide exposure to a number of the largest cap securities in three natural resources sectors, namely agriculture, energy, and metals and mining. This ETF provides investors a broad-based exposure to the commodities sector, which will benefit plenty of companies within the industry given the positive mid to long-term outlook. This ETF holds about 118 different stocks. Some of the top holdings are Shell, BHP Group, and ExxonMobil, which are reputable oil and mining companies in this space with a long history. Over the past 10 years, this ETF has generated an annual return of 4.64%. If you had invested $1,000 10 years ago, your investment would have been worth $1,574 today. The GNR ETF provides a dividend yield of 4.38% while charging a low expense ratio of just 0.4% per year. Due to its relatively stable performance and dividend yield, along with its low expense ratio, GNR is a potential option for investors to consider including in their portfolios. Tactical Play ETF. Last but not least, we have the Tactical Plays category. A good consideration would be the VanEck Semiconductor ETF, which is intended to track the overall performance of companies involved in the semiconductor production and equipment. Some of the top holdings include NVIDIA, Taiwan Semiconductor Manufacturing, ASML, which is the only company in the world that makes the machinery to produce advanced chips. And of course, a well-known name, Advanced Micro Devices, also known as AMD. Although the semiconductor industry is going through a down cycle now, the good news is that bad times will pass. It is difficult to imagine a future without semiconductors, as they are the fundamental building blocks of modern computation. As the world becomes more digitalized, the demand for semiconductors will only increase. Over the past 10 years, this ETF has generated an average annual return of 22.46%. If you invested $1,000 back then, your investment returns would have grown to a whopping $7,584 today. Furthermore, the expense ratio of this ETF is reasonable at 0.35%. And that's it. Here's our list of 6 ETFs you need to construct a $1 million portfolio. Now, we've also refreshed our ETF focus list for 2023. Head over to the various iFast platforms if you're interested in the other ETFs on this list. Thank you for watching and hope you enjoyed this video.